We embark on our third earnings season of 2025 this week. The season kicks off with the usual suspects, the banks mostly, and some other big Dow Jones industrial names. Earnings season is always the most exciting time for investors. It is when some big swings in share price occur and our portfolio value changes drastically. Of course, this can lead to angst or joy, depending on your point of view. But more importantly, earnings season provides a window into the soul of the U.S. economy. Welcome to The Quality Investor. Today's video will be a preview of what is to come for the Q2 2025 earnings season. Over the next 2 months, we'll see all sorts of movement in the market, good and bad, and we'll be sure to see some opportunities as Wall Street can be seemingly unpredictable in how it reacts to businesses' earnings. We've seen poor earnings reports launch a business 10+% post-report and vice versa, a great report resulting in a massive drawdown. But if we are only focusing on buying and holding quality businesses, these drawdowns must be viewed as an investor's best ally. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. The purpose of today's video is twofold. I want to briefly discuss the businesses I am looking forward to this season, as well as businesses I plan on doing videos for. And on that note, as I go through the earnings dates of some of these businesses, please let me know in the comments what businesses you are looking forward to in earnings, and I might feature some of those reports on the channel. The second purpose of this video, though, is to discuss what this latest earnings season can tell us about the state and direction of the U.S. economy. We're going to discuss this second point first, as I believe it can set the foundation of how we ought to parse through earnings reports and make sound investing decisions with our investing dollars. In my view, earnings season is the best proxy we have to determine the state of the economy, as well as the direction the economy is heading. Of course, many argue that we can just look at GDP and be done with it. It is a topic for its own video, but GDP, or gross domestic product, is limited in scope, doesn't account for future growth like earnings guidance does, and includes government spending. Serious arguments can be made that a significant portion of government spending is wasteful and not productive, and it also uses debt-funded spending, which saddles future generations with that debt. Corporate earnings, however, reflects real results of business operations. And many businesses provide guidance on the next quarter or fiscal year, which can give us an idea of what future demand and growth is for those businesses. So, what are we looking for as we assess earnings season? The main indicators I look at are as follows. Number 1, earnings and margins versus expectations. Number 2, capital investment. And number 3, consumer confidence. Earnings in this context incorporates revenue, margins, earnings per share, and free cash flow. But we want to view it against what others are expecting. So a beat for revenue or earnings might be seen as a positive. I say might because estimates themselves can be flawed. They are just guesses. So we have to look at how we got an earnings beat. 2 important factors to look at here are revenue growth and margin expansion. If a business sees a revenue beat, the best case scenario here is organic revenue growth. Revenue that grew from price increases, new business, and so forth. If a business beat revenue because of some one-off type sale or differences in accounting revenue recognition, then that is really not a positive sign. This leads to assessing margin expansion. Expanding margins is an excellent indicator of value creation. A business with pricing power can increase prices while costs remain the same. This growth in revenue leads to higher margins and points to a healthy and growing business. Margin expansion can also come from improving efficiency, another positive sign. Earnings growth or margin expansion from cost cutting may be a neutral sign, but it can also signal a business potentially in distress. Another component to beating estimates is forward guidance. The market typically reacts positively to businesses that raise guidance or guidance comes in higher than expected. A business does this when they're optimistic about future quarters. Perhaps demand is stronger than expected or previous investments are starting to bear fruit. As earnings season moves along, a strong majority of businesses beating their expectations generally indicate improving economic prospects. Capital reinvestment is the fuel for business growth. In an earnings report, we want businesses to show a willingness to invest in their future. This can be spending on equipment or factories to expand product lines, or increasing headcount in anticipation of higher demand. This type of spending indicates economic recovery or expansion. A well-managed business will only take on capital projects when it believes the return of the project exceeds the cost of that capital. When businesses have an optimistic belief about the future, they are willing to take more risk and seize opportunities like market expansion or, as we are seeing in big tech, invest in cutting-edge technology like AI. Amazon, Google, Microsoft, and other big tech firms have done record-breaking CapEx spending in 2025. I discussed this a quarter ago. Interestingly, the market viewed this as a negative, at least in the short term. See those videos for more detail, but the market saw this investment more as spending or profligate investment rather than what it is, investment in the infrastructure of the 21st century, artificial intelligence. Conversely, reduced capital spend or firms scrapping capital projects is generally a negative sign. If a business believes troubled times are ahead, they may want to preserve cash for a rainy day or strictly spend on maintaining operations rather than expanding them. And that's another point. CapEx spend is generally a positive indicator when it is growth-oriented rather than just CapEx maintenance of current operations. This can be parsed out through earnings calls, presentations, and 10Q reports. A more indirect cue we look for during earnings season is rising consumer confidence. This isn't going to be a direct metric in an earnings report, but we can look at the performance of certain sectors and industries to form a strong opinion. Are firms that sell luxury goods seeing a surge in sales? How about the retail industries? When business after business is posting year-over-year growth or even strong sequential growth, that generally indicates that consumer confidence is strong or growing. Travel and leisure spending is another good proxy of consumer confidence. I'll get into more detail in a minute, but businesses like Visa and MasterCard are excellent barometers of consumer confidence as they report consumer transaction volume and spending. One important factor we're watching for this earnings season is how tariffs impacted spending. We are seeing record collections and tariffs, but has this translated into inflation or lowered consumer spending as businesses might pass tariffs on to their customers? Businesses that import many of their goods or supplies will help answer this question. Apple, many semiconductor businesses, and retailers like Walmart and Amazon are key bellwethers here. And on that note, let's preview what earnings are coming up the next couple of weeks, as well as what businesses I have my investor eye upon. As always, earnings season starts out a little bit slow in the first week. We have Fastenal reporting their earnings this morning, but then some of the bigger banks release on Tuesday, especially before the open. We have JP Morgan Chase, Wells Fargo, Citi, BlackRock, State Street, a lot of big names there. And then throughout the rest of the week, some other big names like Goldman Sachs, ASML, Johnson & Johnson, TSMC, Netflix, and Pepsi. All of these are businesses I like to keep an eye on, and I'm especially looking forward to both ASML and Netflix. For those that are longtime watchers of this channel, I don't typically cover banks. Banking is a vastly different type of business model than the subscription style tech-based companies I like to invest in, or the Visas and MasterCards of the world, and I just don't care to learn it that much. But then we close out the week with 3M, another Dow Jones industrial business, and American Express. American Express is always an interesting earnings report to look at because it's a good preview of what will happen with Visa and MasterCard. So this first week, ASML and Netflix, and then to a lesser extent, TSMC will set the tone for my style of investing. Honestly, I would love to see Netflix have a bit of a drawdown. I just released a video regarding how I believe Netflix is a great business to invest in, but it's a little bit too expensive. Looking at the rest of July, however, this is when things really start to heat up. The second week of earnings season here, we see a lot of the semis really start to report here. We have NXP, Texas Instruments, and Intel, and that'll give us a good baseline of how the recovery is going in that industry. We also have a few discretionary businesses reporting as well that'll give us a good idea of how the consumer is going. We have Domino's, Coca-Cola, Chipotle, and even Southwest and Dr. Pepper reporting in that week. But the real earnings this week are going to be the first of the Mag 7 businesses. We have Google or Alphabet reporting, as well as Tesla. Tesla, of course, is one of the more volatile stocks in the market, and every earnings report is a roller coaster with Elon Musk. And we always have eyes on Google. Right now in Google, what we are looking for is how is search growing compared to all the bears out there claiming that search is dead. But more importantly, what is the rest of their business, specifically Google Cloud Platform and YouTube, doing? If you watch my channel, you know that I believe Google's real future lies in those two business lines. One of the three things I mentioned to keep an eye on was capital investment. And you can see here, a lot of these businesses require a lot of capital investment. NXP, Texas Instruments, Honeywell, Intel, of course, Union Pacific and CSX. Are they making investments to spur more growth, or are they just maintaining their businesses? We want to see investments that are spurring growth out of these businesses. That will indicate where our economy is headed. Of course, Alphabet, who's expected to have a massive CapEx spend in 2025, are they continuing that pace? That's what we want to see there. And then coming to the final week of July, we have some more economic bellwethers, especially in the consumer sector. The first big one of the week will be Visa, but we also have Booking Holdings, which would be a good proxy for the travel and leisure market, as well as Starbucks reporting on that Tuesday. To a lesser extent, we have Procter & Gamble, which will give us a good insight into the defensive consumer market. But then on that Wednesday, we have two more Mag 7 giants in Meta and Microsoft releasing. Always have an eye on these earnings. And then on Thursday, of course, we have Apple. Apple, of course, will give us a good idea of how tariffs have affected their business. But with Visa, they also provide very good commentary around how the consumer is doing in their earnings reports, really their earnings calls. And we can see how the consumer spending habits have really been altered, if at all, by the tariffs or any other sort of economic slowdown when Visa releases the report. And then a few other businesses I want to keep an eye on: Cadence, Lam Research, S&P Global, and KLA. All businesses I think are very interesting and are on my watch list. I'd like to see if they are coming in any sort of buy territory. A few other big names that are not on this list that we're keeping an eye out, they don't release until August: Amazon, Applied Materials, Intuit, and Fortinet, also Airbnb. All of those will provide really good insight into both tariffs and consumer confidence. Of course, with Amazon as well, we're going to be looking at their CapEx spend. So the next 3 to 4 weeks is certainly going to be a whirlwind of earnings. It's going to be very interesting to see how the American economy is performing right now. And like I said, if any of you have certain businesses that you're keeping an eye on, please let me know. And I would love to put out a video discussing their earnings. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.